In just 48 hours, President Trump sealed a bizarre new trade deal with China. The question everyone is asking, did Xi Jinping actually win the trade war? And what was the real price Trump had to pay? In early 2025, Donald Trump stunned markets by unleashing a fresh wave of tariffs on Chinese imports, signaling a return to the trade war playbook he first launched in 2018. On 1st February, he imposed a 10% levy on all Chinese goods, citing concerns over drugs, supply chains, and America's trade deficit. Within weeks, Beijing retaliated. Tariffs on U.S. coal and LNG rose by 15%, while heavy export restrictions were placed on tungsten, indium, and other strategic metals. Trump met Xi Jinping in Busan, South Korea, and announced a significant shift. The U.S. would cut the effective tariff burden on Chinese imports to roughly 47% from 57% by halving the tariff tied to fentanyl precursor shipments to 10% from 20%. China, in turn, agreed to suspend new export curbs on rare earths for a year. This moment matters because it marks a pivot, from aggressive escalation to tactical truce. The story is not just tariffs or trade. It's about geopolitics, power projection, and the global economic backdrop. Markets reacted. Gold prices jumped nearly 2% as uncertainty spiked. Trump casting tariffs as leverage ahead of a possible re-election bid, Xi framing cooperation as strength after years of U.S. pressure, and global investors, supply chain managers, and exporters caught in the middle. What remains to be seen, and what we'll unpack next, is whether this twist is a genuine reset or simply a pause in a broader competition. In the lead-up to the renewed tariff push against Xi Jinping's China, Donald Trump's calculation was as much political as economic. Domestically, he cast the tariffs as a pillar of his Bring Jobs Back narrative and flagged them as a tool to address America's opioid crisis, specifically citing China's alleged role in precursor chemicals for fentanyl. Strategically, the timing aligns with his re-election campaign frame. Appearing tough on China helps shore up support in manufacturing states. At the same time, the administration framed the move as retaliation. Trump announced a potential 100% levy on Chinese goods and broad export controls in October 2025, following Beijing's rare earth export curbs. On the diplomatic front, China responded cautiously. While Beijing agreed to explore talks, it made clear that its expectations were modest, and it viewed the latest summit more as a tactical truce than a strategic reset. Economically, the narrative pitched to the American public was that Chinese exporters would bear the cost, but real-world data contradicted that. According to a Reuters study, imported goods became about 4% more expensive for U.S. buyers, suggesting domestic firms and consumers were absorbing much of the hit. Public reaction has been mixed. A survey in August 2025 found that 55% of Americans believed the long-term effects of the tariffs would be mostly negative for the country and for themselves. By prioritizing short-term political wins, the U.S. may lose strategic leverage if China shifts to deeper regional alliances or supply chain resilience, leaving America exposed. The question now, can Trump's domestic narrative deliver results while China quietly consolidates abroad? And how will that shape the next phase of this tug-of-war with China? In the shadow of the headline-grabbing tariff drama, Xi Jinping and his team in Beijing have quietly engineered a set of moves that suggest China is not simply reacting, but actively shaping the second act of the trade war. Politically, economically, and diplomatically, the country has shifted from head-to-head escalation to layered strategic positioning. From the diplomatic angle, China has intensified outreach to alternative markets. In September 2025, exports to the U.S. fell 27% year-on-year, while shipments to the European Union, Southeast Asia, and Africa rose by 14%, 15.6%, and 56.4% respectively. That diversification reduces dependence on the U.S. as a customer and as a bargaining chip. At the same time, Beijing rolled out export controls on rare earth elements and critical magnets on 9 October, creating leverage far beyond traditional tariffs. Economists flag this as China moving from purely reactive to proactive terrain. On the economic front, China's export engine continues to hum. In September, China's export engine continues to hum. In September, exports rose 8.3% year-on-year, exceeding expectations of 6%. Meanwhile, domestic demand is faltering. Q3 GDP growth slowed to 4.8% from 5.2% in Q2. The combination shows China leaning into its strength, exports, while implicitly acknowledging weakness at home. In doing so, Beijing gains a narrative. Our economy can endure U.S. pressure. Globally, this repositioning sends a signal. China is no longer just playing defense, it is rewriting the script. At the International Monetary Fund and World Bank meetings in Washington, senior officials noted that many countries are accelerating regional trade deals and supply chain shifts outside the U.S.-China axis. That trend aligns with Beijing's push in forums such as the Regional Comprehensive Economic Partnership, RCEP, and its outreach to Africa and Latin America. But the risk is real. By relying heavily on exports and global diversification, China leaves itself exposed to a sharper collapse in Western demand or a sudden U.S. escalation of tariffs or sanctions. Also, the record-breaking volumes of steel exports, forecast to reach 120 million tons in 2025, may trigger fresh protectionist backlash. The renewed tariff cycle did not stay an abstract policy spat. It translated quickly into real costs for households, firms, and markets. Early empirical work shows imported goods sold in U.S. retail outlets were about 4% more expensive after the tariff round began, while some domestic substitutes rose roughly 2%, signaling that American consumers and companies were already shouldering much of the burden. That price transmission maps into several immediate channels. First, consumption patterns shift. Higher prices on consumer electronics, clothing, and intermediate inputs raise living costs and squeeze margins for firms that cannot pass costs on. Reuters reporting found many U.S. firms absorbing tariff costs to avoid losing market share, delaying the advertised pain for consumers but eroding corporate profits. Second, financial markets have been volatile. A two-step process. The initial tariff announcements in spring sparked a sharp sell-off and safe haven buying, with equities and commodity markets tumbling amid recession fears. Later, when diplomatic progress raised hopes of a tactical truce, markets rebounded. Stock indexes rallied on expectations of easing tensions and a clearer growth path. Investors are now pricing a high degree of political risk into valuations, making markets reactive to summit-level signals as much as to fundamentals. Third, global supply chains are reconfiguring. Firms front-loaded shipments, diversified suppliers across Southeast Asia and India, and accelerated onshoring plans where feasible. The IMF flagged these shifts as a double-edged sword. They boost regional trade in the short term, but raise costs and lower efficiency, trimming global growth by compressing trade-intensive activity. The IMF explicitly called further U.S.-China escalation a significant risk to the global outlook. Winners and losers are unevenly distributed. Exporters in alternative markets, Vietnam, Mexico, parts of the EU, and commodity producers front-loading shipments saw temporary gains. U.S. manufacturers that source inputs domestically faced higher input costs and lower demand. Emerging markets reliant on export markets tied to either power could see growth volatility. Asia's 2025 growth was upgraded slightly because of front-loading, but the IMF warned growth could slow in 2026 if tensions persist. Risks and scenarios remain stark. A sustained tariff regime could shave off up to 0.5 to 1.5 percentage points from U.S. GDP growth in adverse scenarios and push global growth down through trade and confidence channels. Central banks face a dilemma. Higher tariffs can be inflationary while growth weakens, a policy mix that complicates rate decisions and financial stability. If tariffs become a long-term tool rather than a bargaining chip, businesses will permanently reorganize supply chains and investment flows, raising the prospect of a more fragmented, less efficient global economy. How resilient are U.S. industries and global markets if the current pause becomes a protracted new normal? That question leads directly into the final verdict. Who truly gained, and at what cost? As the dust settles, the verdict on Trump's tariff twist is anything but straightforward. On the surface, the former president appears triumphant, projecting toughness on China and reclaiming control over America's trade narrative. Yet beneath the theatrics, economic data and geopolitical signals tell a more complex story, one that suggests Xi Jinping may be playing the longer, quieter game. Politically, Trump has achieved what he wanted domestically, the image of a leader who stood up to China. It's a message that resonates deeply with blue-collar voters and manufacturing states still skeptical of globalization. But economists are skeptical of its substance. The U.S. trade deficit with China, once Trump's prime metric of success, actually widened to $282 billion in 2025, according to U.S. Census data, as companies rerouted supply chains through third countries. Goods still reached America, only the shipping labels changed. Meanwhile, Xi's strategy seems less about counterpunching and more about endurance. Beijing weathered tariffs through diversification, deepened ties within the Regional Comprehensive Economic Partnership, RCEP, and quietly strengthened trade corridors in the global south. According to the IMF, China's exports to developing economies grew nearly 20% in the first 3 quarters of 2025, a structural shift that cushions its exposure to Western pressure. Diplomatically, Xi capitalized on global fatigue with economic fragmentation. At the UN General Assembly in September 2025, Chinese delegates framed the U.S. tariff policy as a threat to global growth and positioned China as a stabilizing force. Several developing nations echoed that sentiment, aligning with Beijing's call for economic multipolarity. This soft power resonance, subtle yet strategic, contrasts sharply with Washington's transactional tone. The broader consequence is ideological as much as economic. The U.S. is reasserting control through confrontation, while China is redefining leadership through endurance. Both claim victory. But the metrics differ: America's political optics versus China's structural advantage. If Trump's tariffs serve short-term politics, Xi's restraint might secure long-term positioning. The real question, then, isn't just who won the trade war, but whether this round of economic brinkmanship signals America's resilience or reveals the limits of its leverage in an increasingly multipolar world. And as both nations eye 2026, an election year in Washington and a test of economic stamina in Beijing, the trade war may be less a battle ended and more a rivalry entering its next, more strategic phase. In the end, this trade war isn't about tariffs or trade deficits. It's about who defines the next era of global power, America's muscle or China's method. But what do you think? Did Trump reclaim leverage, or did Xi quietly win the long game? Share your thoughts in the comments. The debate has only just begun.